Hello, it's Wednesday the 19th, and with a break in the rain, I thought I'd pop out for the market brief. The employment data yesterday was encouraging, but not spectacular. The unemployment rate fell 0.1% to 4.8%. That is less than last month, but the trend remains positive, and it looks like peak unemployment will be lower than originally feared. However, alongside the inflationary threat facing the economy later in the year, we could also see a shortfall of skilled labour. Comments accompanying the employment data covered what they're calling a surge in ambition from those working in hospitality. What that means is the sector that was hardest hit by lockdown layoffs and furlough is more likely to see staff bin the idea of returning to those jobs, moving instead towards more stable employment. That leaves those hospitality heroes like bar staff, waiters and kitchen staff in relatively short supply as the sector reopens. We also saw a nod to the inflationary threat. There was a rise in the 3-month average earnings from 4.4 to 4.6%, and that was ahead of today's inflation data, which may trigger a bigger market reaction than we saw yesterday. We touched 142.20 against the dollar yesterday, and we kick off this morning around 141.90. But there is suggestion that there may be sufficient momentum to challenge the 2021 high of 142.43 seen in February. Over in the US, the jobs market could do with a bit of a boost, help shake off that shadow cast by the big non-farm payroll miss. Yellen seems to have adopted an attitude, perhaps reflecting the mood of the country, of wanting to see the recovery whatever the cost. So if $1.9 trillion wasn't enough stimulus, maybe try $3 trillion. The only trouble with that is that someone has to fund it all. And who has the deepest pockets for US debt? China. But while the threat of that trade war remains, this could be a huge leap of faith from the US, and they'll really need to back their diplomatic skills if they're going to take that risk. We have the FOMC minutes due this evening, which will probably set the market tone for the rest of the week, but given the comments from the Fed members that we've seen since the meeting, it looks unlikely that they discussed any change to policy in any great depth anyway. The outlook is likely to remain that tapering the bond purchases may start early next year, and then perhaps a rate hike in 2023. And all that leaves the dollar index under pressure. We broke the 90 level yesterday, dropping to 89.70 as euro dollar rose to around 122.35, and that's where we open today. Right, well, stayed dry, didn't need the brolly. That's a win. Join me again tomorrow.
If you do not have a clue, then just tweet through and ask FX Blue. Yeah.